Today I want to discuss, investment strategy for 2023. And to start, I just want to share what's happened over the last 4 years. In 2020, we had federal outlays surge 50%. We had Fed funds at zero plus quantitative easing going pretty aggressively, and we had a positive yield curve. In 2021, we had M2 surge 30%. Fed funds were still at zero, and we were doing QE, still had a positive yield curve. And then in 22, we had nominal wages and salaries increase about 7%. Fed funds were zero plus QE until March, and then we reversed that, started raising rates, and then we now have an inverted yield curve. So looking at 23, federal outlays are down 6%. M2 is down 3% and looks like it's going to decline further. Fed funds is almost at 5% and set to increase more, and the yield curve is set to invert more. So we have a very different investment climate than we had coming into the year. So I want to just talk about what's driving it and where we see things going. So I'll start with uncertainty has risen clearly following Russia's invasion of Ukraine. You've seen an elevation in uncertainty. And now when you look at the drivers going back the last 6 years, I think one of the things we're dealing with isn't just the Russian war, but the cumulative effect of all the issues that we're facing. So from Brexit to U.S. fiscal cliffs, to U.S. elections, to trade wars, to the pandemic, to the war in Ukraine, and now the increased tensions around the South China Sea, Middle East, and on and on. So now you're in a very, very uncertain world with a lot of disruption going on in the different areas that impact really all aspects of society. So you're seeing it in the street protests we were talking about minutes ago. You're seeing it in the political discourse around the world. You're seeing it in how companies are reacting and acting to the environment we're in. All these forces that drove the uncertainty actually led to very big distortions in the economic activity, mainly stemming from the pandemic, but then followed by conditions with the war really disrupting how energy flows around the world. All this has led to a negative impact on consumer sentiment. You can see how dramatically it's declined. It did pop at the beginning of the year. We had a very positive January, and then we saw some higher inflation readings. Today we had the Conference Board's consumer sentiment drop 4 points down to 102. You had some other negative sentiment numbers coming. You had one of the PMI numbers came out in a contractionary state too. So you're having these big cross currents, and a lot of the uncertainty is weighing on people's outlook. So what I want to do is take a couple minutes and talk about the three things that matter for us for securities valuation and what the outlook is for inflation, interest rates, and corporate earnings. And also to just think about the lag effects of policy, because I think that's one of the things that's really tripping people up. So the short version is our view is the markets are coming around to the Fed's view of inflation. The market was anticipating the Fed pivoting and bringing rates down. The market's coming away from that rates are going to be held higher for longer. The Fed is going to have to fight inflation more because the employment picture, while it's changing pretty dramatically with the layoffs, we still have a very tight labor market, although for the first time in a while, you're starting to see companies say they're finding it easier to hire. But the big change for us is that inflation, interest rates are going to stay higher for longer, and that's a big adjustment process, and I'll show you in a minute just how dramatic the difference is in 1 year. I think in the corporate earnings area, you have big swings in what the outlook from strategists are for earnings. The fact that average consensus is about 219. I think Nancy Lazar is one of the more negative ones, is looking at 189. I think around 205, you're seeing a lot of other people, but the real issue is you're not going to have multiple expansion that we've relied on with zero interest rates for so long, and we're back to where fundamentals matter. And I think Warren Buffett's letter is going to be a reminder for people that you're going to have to get back to corporate earnings grow over time. They don't get these turnarounds in 1 quarter. You have to look at investing for the longer term, and we're not going to get the benefit of multiple contraction because of zero interest rates, or multiple expansion because of zero interest rates. We're going to have the opposite. So I think that's a big issue. I think one of the most troubling issues for the markets to understand is the stimulus that's been bleeding into the system for the past 2 years is still providing stimulus at a time that we're seeing corporate layoffs and higher inflation, and the tightening measures that were started over the last year are still not being fully felt. And I think that's what's really tripping people up about the economy today. So let's just take a look at each of these areas. So this is the expected change in prices over the next 12 months in the University of Michigan. And you can see that's coming down, but that was as of the end of January. And we know the February numbers kicked up. You can see core PC, which is the Fed's favorite inflation number, was trending down, but also popped up in January a bit. So you are seeing some of these inflationary pressures. I'm not particularly worried about the 1 month changes. I think we're in one of those periods where we were due for some reversal in some of the numbers. And I think you really have to just look past some of these short-term issues and think where the trend's going, because we see some real deflationary pressures coming through the system. And that is playing out in material ways. And the companies are laying off. They're going to be under a lot less pressure to raise wages. And we think that that's going to change the dynamic on inflation quite a bit. And you've had energy prices come down, and we've gotten the gift throughout the world of warmer energy this year. But this is really the slide that to me is the most telling. And when you think about what a difference a year makes, and just look at the 1 year treasuries were at zero basically, and now you're at 5%. And if you flip back, and we're going to talk about asset allocation a little bit later, but the investment strategy that you employ with a zero interest rate environment versus a 4% interest rate environment, if you use the Fed's proxy rate, which I'll show you in a minute, is at a much higher rate, you would take a very different approach to how you value securities and what really matters in how you're looking at your investments. So I think this is really a big issue and something that the market still hasn't fully adjusted to, which is why the hope is that the Fed was going to pivot and bring rates back down. And I think this adjustment process is going to be one where we go back to investing the way it was before we started monetizing everything. So I think that's the biggest change, and one that people are still struggling to get their minds around. You're seeing it in the valuations of both public and private market securities. You're seeing in the valuation of bonds and art and housing as well. This is all playing through. We're now back at 7% mortgage rate. So you are starting to see some of the issues that were working in favor of inflation starting to work against it and slowing down the economy. The shift from QE to QT is really something I think is being underestimated. And this is the Fed funds. San Francisco Fed came up with a proxy rate to factor in quantitative tightening. And what they're saying is now we're moving, this is as of January, but right now we're moving closer to a 7% rate when if the Fed raises 3 more times, you're going to be close to 7% effective rate for the Fed proxy when you consider the tightening that's going on. And I think that's the other part of the shift that's not being fully factored in and will weigh on the system for some time. And then lastly, when it comes to corporate profits, I think just back on where we were a minute ago on the quantitative easing and the rise in rates, 39 companies in the S&P, I think, or 39 major corporations in the U.S. were filing for bankruptcy already this year. So some of the pain that they were able to avoid in zero interest rates, they're not able to avoid now.
We talked about that in Naples.
Yeah.
Because very little issuance was coming out, and the duration is getting smaller.
Yeah, so I think this is what Anna was referencing there, and you're starting to see that play out. And that's going to come through, and I think that's going to show what we're saying here. While corporate profits continue to rise, they're not going to be shared equally. A lot of companies right now are finding that they cannot keep their higher prices, that they have big inventories, so they're starting to have to make discounting. So that this means that you're going to have a pretty significant have and have-nots in the corporate area. But I think, I've said this for some time, we think there are 3 have and have-nots scenarios, the 3 inequalities. You have country inequality, so you really want to think about which countries you're investing in. You have corporate inequality, and then you have individual inequality. I think the corporate inequality has been hidden by zero interest rates, and now you're going to start to see where fundamentals matter and earnings and margins are going to matter more than they have in quite some time. And I would say even probably going back to the mid 90s, because from the time the tech bubble really started to take off, we were really more focused on growth, except for the couple periods where we had disruptions, the tech bubble bursting and the like. But more so, it's been about growth and future earnings, not current earnings and profitability. And when you move into a higher interest rate environment, I think that all changes. So for us at ARS, we think there are three things that you really want to focus on that are the three big shifts. It's this global fragmentation that's coming out of the war, but it's also further back than that. It goes back to the trade wars and the desires of China to displace the U.S. As the leading nation, and China and their like-minded partners. It's also the challenges that we're seeing in the West in terms of how we're holding together and what happens with the outcome from the war. I think is going to be a key element of how we move forward globally. I think the other big issue is this cost of living increase that people were hoping was going to be transitory, but now is going to much more permanent element that we're going to be living with, accompanied by higher rates for some period of time. And then the third element that I think is the biggest investment opportunity is the reindustrialization of the global economy. And I think when we think about that, each area, each region is going through a reindustrialization. We were relying on China to be the manufacturing hub for the world, and that's now shifting. The beneficiaries are being sent around to different areas like India, Africa, and North America. We think that each of those areas are going to be uniquely positioned to win. There will be other winners inside Europe and other pockets, but this reindustrialization is going to move a lot of money around and give investors a really clear view of where to invest. So for U.S. investors, you want to invest where the government's telling you they're going to be putting money. The Inflation Reduction Act, the CHIPS and Science Act, and the National Defense Authorization Act. Big spend going to areas that are guaranteed for the next 10 years to be receiving significant funding at a time that other areas are going to get money pulled away from them. So I think that that's the way you want to think about it. If I'm thinking about investing in China, I think about the companies in the U.S. that are going to be expanding in China will more likely be the ones that are retailers going after the consumers that aren't a threat to the government from their strategically vital industries. And if you want to invest in Chinese companies, invest in the ones that are the strategically vital ones that the government's going to back. And you can see where you want to go. And the same thing for Europe with their energy transition. You can see where you want to invest there. So I think there are pockets of opportunities. The themes will be similar, but the execution will be very different. So I think the beneficiaries of the world we live in will be those that are involved in the clean energy transition, both fossil fuel and renewables. I think the digitalization, we haven't seen productivity increase the last couple of years. We think we're about to enter a massive phase of productivity increases. National security is going to continue to demand more of security, more supply chains and reorientation of supply chains to make sure nations have all the vital elements that they need, whether it's rare earths or steel or other materials. And then the biotech area is the other area that I think is going to be one where we have to lower our healthcare costs. People are going to be living longer, and we have to do more in that area. So these are the areas that you can see clear capital flowing to. And then lastly, given the dynamics of the global economy, we think over any reasonable period of time, long-term bonds are going to be a terrible investment in this environment. And just to give you one big difference between now and 1980, if you think back when Volcker was raising rates, we were having positive, you still had real rates of return. Now you have negative rates of return on that. So it's a very different environment than we were looking at then. That's not a great environment for bonds to do well in. Whereas with Volcker, we were bringing them down from 20% down. You were almost getting guaranteed returns that way. So Mark, I'll stop there and open it up, and then we have
What do you think of short duration?
I think the 1 to 2 years free money, and you're getting almost 5% now in that area.
And if you're in California paying high taxes, some of these munis, short term.
Some of the munis are, but the states are flush right now with cash. Will they be in a year? They had all these revenues coming in, but now they're starting to get some other bills, like New York City's thinking they're going to lose $12 billion from commuters not coming in 5 days a week. So when do those bills come due? I think that's one of the things that you have to worry about the municipalities still.
So I'll open up for questions. I do want to transition to Bill soon because you've sort of set the stage for what we're asking everybody, how they see the future as well on a global basis. So, but any questions, comments on what Stephen just raised?
I do. Henry here. Just a quick question, Stephen. Just curious, for those who lived through the 70s and the early 80s, or those who study extensively, Mark Twain has a quote, history never repeats itself, but it rhymes. Do you see sort of the inflationary environment will be sustainably high, sort of similar to the 70s or not?
I don't think we're going to have the spikes like we had in the 70s. We had some dynamics there that were different than we had today. And I think a big part of it is this is what the Fed's fighting. In the early 70s, we took the foot off the gas pedal and reduced rates in, I think, 73 under Arthur Burns. And that actually spurred the inflation back again. And if they didn't cut rates then, you might have had a very different picture. So that's one element of what the Fed's got in their mind and what the street's not, I don't think, is reacting to as well. I think the other element that really drove a lot of the inflation was the cost of living increases that were booked into so many of the union contracts, and the unions were a much bigger part of the labor force, and you were getting massive increases when companies were losing money because they weren't able to pass on the prices to their consumers. So I think there were some differences there. I think there are some similarities, though. We had energy crisis in both periods. You had labor issues that were, they were going through some different labor issues. In 81, we had the highest unemployment rate, I think, since that we've had any time since.
But we were not in an exporting position.
No, we were in a very different position there. And we were a manufacturer too. That was before we had the carve out of our manufacturing. So you have had a big reversal there. So I think there are some similarities, but there's some differences. And I think you really have to think about the one big difference now is we're looking at just shy of $9 trillion on the balance sheet. And that's money that's still in the system that's coming down. And that tightening, how long can they do that? And what is the impact of it? Because we've never had tightening to this degree. So I think that's one of the big wild cards. And I think people are going to start to focus more on the quantitative tightening once the Fed stops raising rates. And then all of a sudden people are going to say, how do you get down to a reasonable level? And the other element is, can the Fed ever get back to 2%? I think it's going to be the big issue too. I suspect that most economists would say it's a lot easier to get from 8 to 4 than it is from 4 to 2.
Right. Andrew?
Good to see everybody again. I feel safe asking this question since he was a guest on last week's meeting. And I won't mention his name because it's polarizing and it's not an endorsement for him either. Given the juxtaposition from the prior administration to now, and taking the personality out of it, are there any core policies, Stephen, that you think are missing right now that have had a ripple effect on much of what you covered today?
If there's one, there are a couple of things that I would change if I wanted to fix the country. One is obviously we've talked about immigration, but two is if you're gonna put money out into the system for competitive advantage for national security, then back it up and put the permitting on a faster track. Make sure you can get the money into the system as fast as possible, because we're in a war. We're in an economic and technological war right now, and you don't put obstacles in front of yourself. And I wouldn't vilify the corporations that I want to partner with to help us get there, because you're competing against a really incredible competitor in China. Yeah, they're a massive force to reckon with, and we can't do it by just half-assing it. And I think they got to take some of the obstacles out to do that.
Kiraj?
Yeah, so mine is regarding the interest rate. You mentioned that we're trying to get it down to 2%. But
The inflation rate.
You're talking about inflation.
yes, the inflation rate. Yeah, and also like the interest rate at the same time too, because if you bring it down, then there's going to be more monetary movements and everything like that. But one thing that we haven't had in the past that has been part of the system within our average trending happening for especially past 10 years, I would say mostly past 5-6 years, is cryptocurrency. So do you think if you want to control the inflation and interest rate, you have to control cryptocurrency too, like regulate it to some more than to some extent? Because within a year or two, we're gonna have a movement that's gonna happen that the interest rate, not the interest rate, the cryptocurrency will have the Bitcoin halving, and the prices will shoot up again. So you can't control it, but all of a sudden Bitcoin will turn to $100,000 and all that stuff because it halved and the supply.
Josh, I think it's a more nuanced, multi-factor discussion, which we need to revisit.
Okay.
Yeah, it's interesting because the BIS just came out with a speech on incorporating the future of money again, and there's room for both. I don't think they're going to be mutually exclusive in the financial system, but I don't think it's going to impact rates that much because I believe that that the crypto market, in terms of the overall market, isn't big enough yet for it to really impact rates.
Okay.
Well, Adam, then Michael, then Lauren, and then over to you, Bill Dykler, to talk about our investor survey. Adam.
Thank you, Stephen. Thank you, Mark. Is 2% really the right inflation rate given the changes in the world trade, geopolitics, technology? Is 2%? Why 2%?
Yeah, that's a good question. I don't have the answer to that one. So I don't think they're going to be there. I think they'll be at a higher number when all said and done.
Michael Hammer?
Oh, I love being able to say this. This time it's different. I was listening to NPR Marketplace last night as I was driving, and they played a clip of Volcker, and I actually recognized his voice without them identifying him. So back then, late 70s, going into the 80s, we didn't have this huge tech sector with the really large margins. Now that's a significant part of the economy. Are we looking at margins being squeezed, but they're not actually having problems staying profitable? Or are we looking at something different?
That's a good question. I think you're having both, and it depends on the business. So I think that the guys who can use technology well are getting the benefit you just described, but I don't think a lot of people had the financial wherewithal to make, or the foresight to make the investments to be as productive as they need to be, which is why you're seeing so many people laying off as aggressively as they are, because if they were using technology right, they wouldn't have had to staff up the way they did. So I think you're going to see both. I think you will see some companies show much better margin improvement because they've used technology well. I think you're going to see a lot of people get on the wrong side of that one.
Lauren?
Yeah, introducing my mother.
Special guest?
Yes, my mother, Myrtle Taylor, retired educator, 50 years in Chicago, who will be 90 years young in May.
Nice.
Way to go.
Hello. Okay, Stephen, do you agree or disagree with the following statement that the main driver of the U.S. economy is actually not market demand or supply or any of those factors, but actually monetary and economic policy? Do you agree or disagree, and why?
I would say that our economy is 70% consumer driven. So the consumer drives it. The forces behind the consumer are going to be the environment that the government and the central banks and the business environment create. So policy has a factor in it. but it's really where are the consumers and where are we in the economic cycle that really determines where we are. Everything else is a reaction to that.
Well, maybe that sets the stage, Bill, for everyone to sort of weigh in together. Our anchor man, Stephen Burke, gives us some general guidance, but you want to share your screen as we do our community investor survey round 11.
Right. We'll do. Okay. Well, yeah, good to see you all. Hopefully it's coming through. My computer screens are not rendering properly, so I'm going to have to kind of wing it a little bit. But definitely want to put in a plug for the Asset Survey 11. And in particular, hopefully you all can see the results that I've got up here for our Asset 10 survey. And I think that it's interesting because in light of everything that Stephen said, and I'm so glad that it's going to be on replay because I want to go back and take more copious notes because it was cram-packed with all kinds of very important stuff. But you can see the community, towards the end of last year, was looking for global and U.S. recessions, as of 3/31/23. Well, we're almost there, and we're not there on recessions. So interesting. Fed funds rates, 4%. So we're getting there. The U.S. 10-year, we're getting there. Inflation maybe lower. Well, recent news has come out that maybe it could be a little higher. It's hard to say. So anyway, I would certainly encourage everyone to go to the asset survey to take care of that, because we really, number one, we want to get the views. Number two, we're broadening it out. So you'll see the questions include Europe and UK and Germany, so that we can get a little bit of a more broad-based view on what the thought is amongst all of you out there. We're also trying to, we're also asking for your asset allocation. That's super helpful. I think those of you who saw the chart, last time we presented, some very interesting results in terms of the barbells, that were out there, but in aggregate, the community looked very similar to a broader sample. Additionally, we talked about expected returns, and would love to hear your thoughts on expected returns, because whether you calculate them or whether you have a reasonable guesstimate in terms of what they might be, that is background information that drives a lot of asset allocation. So again, we want to add your voice to the community results. And just to follow a little bit on what Stephen was saying, I came across a couple of really interesting charts that I'd like to share as they impinge on asset allocation. Here is a very long run picture of stock bond. So you've got public equities, public fixed income correlations. This is a 2-year rolling correlation of monthly returns. And you can see very interestingly that we had positive correlation going back to Henry's question, which I think is also really important to ponder, because there are some Stephen said there's some similarities, but there's a lot of differences. But one of the things that we see, back in the late 70s and early 80s, during that period of time, we had very high correlation between stocks and bonds. So in a sense, the diversification aspect of bonds was not there. And I'm going to show you another chart in a second that might lead you to a different thought of what you're thinking at this particular moment based on that statement. But then you can see right around, the .com era, we had a significant shift in terms of the correlation went negative, and in some respects went highly negative, particularly around the .com bust. You could see here another peak in the GFC and further. So, and now we've had another regime change, if you will, or an indication of a possible regime change going back to more positive correlation. So, and clearly that was the case last year, one of the worst years for the 60/40 portfolio ever. So, so again, this is something to keep in mind as you're thinking about asset allocation. Let me move to this next chart, which is fascinating. Courtesy of Wilshire Associates, produced an interesting study, just talking more about where institutions are going to be allocating, and particularly with regard to kind of the magic 7% target, which is the typical rate of return for both pensions, endowments, foundations, sovereign wealth. It almost cuts across. And what allocation do you have to have in order to make that 7%, or your risk taking in terms of that 7%? Interesting enough, early back in the period of time that Henry was talking about, late 70s into the 80s, you could almost do that with 100% bonds, and this is the yield on the 10-year right here in the blue line. So you can actually do pretty well at 100% bonds. But again, sort of moving into the beginnings of the tech craze in the 90s, leading up to the dot-com bubble, as interest rates came down based on Fed policy, you saw equities having to be, you had to take more equity risk in order to get your 7% range. And it went to the point, I'm not sure if this is 100% accurate up here where you have to have 100%, but nonetheless, you had to have a pretty high allocation to equities in order to get to 7% because of the financial repression that the Fed was really putting on QE. And you can see bond yields really coming down significantly. And once again, we're seeing a transition period where we are right now. But I think that this is a particularly interesting chart. And again, you think about what's your risk allocations and how does that translate into asset allocations. So,
Hey, Bill, another element back to Henry's question, and looking at the two charts you just showed, around 1989, the Chinese economy was about $390 billion. So what you saw from 89 forward was really when the BRICS started to develop and take off, and that's when the manufacturing left the US. And you can see then we started to get into the Greenspan zero interest rates, and you can see where things started to change. And I think that China growth and the BRIC growth is one of the big differences between the 70s and now.
Yeah, absolutely. So I think, we're looking very much at where is the new equilibrium going to form, and a lot of debate about what is the Fed going to settle for as far as inflation, what are consumers in the market going to settle for as far as inflation and rates as a consequent number, from inflation. I think, once again, the important point of, we had, back in the 70s, this was still real, positive real rates of return, from the bond market. Now we don't have that. So where are investors, and to a large degree, it's very important where our consumers can be able to have real wages and real returns, very important, and bears down on how we allocate. So, Mark, I'll turn it back to you, Mark.
Okay, great. Thank you. Bill, I'd like to, even though I keep all these surveys anonymous, I'm curious to see yours. You haven't submitted yours yet?
It's coming.
Okay. And Duncan, I'm particularly keen to see how you see our investment survey. Have you opened it up, take a look at it?
I started to fill it out. There's a lot in there, but it feels like, doesn't it feel like it just feels to me like this whole, this fixed income thing versus equity thing, the market's desperate to have the growth equities return and perform. That was kind of the January trade. And the market's desperate for, when will the Fed start cutting rates? And I just wonder, if that desperation tells you we're still too biased to that outcome. And that's like the classic trade on hope strategy. And, inflation's what's really interesting, this whole discussion of the Fed's 2% inflation target. I thought this was going to be a conversation that was going to come up this summer. It's amazing to me how accelerated the realization is that 2% is a dumb target. It's like everybody but the Fed knows they're not going to get back to 2%. And, there's so much discussion of that right now. And it'll be really interesting to see how that gets handled. And, the observation I have is that last year we went through, the Fed raised rates, the administration extended the student loan, program so people didn't have to pay anymore. The Fed raised rates, they put subsidies on electric cars. It's kind of like there's been no policy from the government to help the inflation fight. And interestingly, you had a former Fed chairwoman in a key role in the administration. Now we've added another one. So there's two people that have spent a lot of time at the Fed, and had been involved in fighting inflation. And they're now key components of the administration. And, it'd be really nice to see some policy reform to fight the inflation battle instead of just dumping the whole thing on the Fed. I'm curious if anybody has views on how that might play out.
By default, it's going to go to Stephen.
I'm thinking through your question, Duncan. I think if you want to cut inflation, you're going to have higher unemployment in this environment. We have too tight a labor market. So I think the battle that the Fed has right now is it's been dumped in their lap. They don't want it dumped in their lap, but they're stuck with it. And if you're Powell, you're going to have to hold the line that you're fighting inflation until inflation's coming down again. And they're worried about a month like last month to hold the line. So they're not going to move off of 2% until they get inflation back down closer to 3%. I don't think they'll be able to do that. I think the policy is to get you there. I think if they're putting money out into the system, you got to get it into productive spend. So that's where the permitting process and accelerating the infrastructure spend and the things that they're talking about doing, that has to be done as fast as possible, because a lot of it, when you're reorienting supply chains and the like, is inflationary to start until you get the scale, and then it starts to come down. But a lot of it's still by definition going to be inflationary when all said and done. Your baseline will be higher after. So I think they don't have a lot that they can do other than get the money into the system that they're trying to put out, get productivity up. And if you get productivity up, you'll be able to rein in the wage inflation and you'll have less of a hiring challenge. But I don't think they have a lot that they can do. But I do think the Fed will not acquiesce to the street's desires until inflation is better moderated. And I think they're going to just stay with the story and everyone's going to criticize them for it. But I think it's actually probably the right thing to do. And I would say that one of the things in the back of their mind is that a lot of people think that the transitory issue that they got criticized for, that it really was transitory without the war, and that now they're worried that they're just going to see some transitory stuff, and if they go too far the other way, they're going to be caught off guard too. So I think they're in a tough spot at the Fed. I think they're just going to hold the line and keep doing what they think is the right thing and not worry about the rest of it.
I mean, do we have to worry about going to 6?
I suspect not. I think the quantitative tightening is going to be the thing that the market wakes up to, and that's going to. And I think that we started talking about the layoffs. I remember back in May and June when I raised the layoffs starting and people thought they weren't that big because it was only 40 companies, but the trend was accelerating. And when you see what that's followed through, I think you'll just see more of that coming too. So I think that starts to moderate the inflation because wages will be not as aggressive. So I think you'll have higher inflation, but not to where the Fed's going to have to go too much beyond what they're already doing.
Any other comments? I know Adam's back with a question.
Other than employment, what are the other levers or signs of reduction in inflation?
Housing.
Say that again. Housing.
Housing. Yeah, we had house prices that were all distorted because of the pandemic, and you had people shifting with their jobs and workflow. So you had these economic distortions that are going on throughout the economy. So when Ed Yardeni's talked about rolling recessions, he's seeing pockets get hit in different periods throughout the last couple of years. So one of the reasons why people think we might have a no landing is because we've had so many pockets of hard landings inside the economy already. The one area you haven't had it is housing. And housing is starting to show some signs where over the next couple months, you could really start to see some of the pressures in housing come down, and that would actually provide some ease on the system as well.
Yeah. I'll just follow up on that as well. There was an article in the Wall Street Journal this morning about, potentially rents coming in because there's so much more new supply, particularly in the Southeast.
Yeah.
And, when I was at my last family office, talking to a lot of real estate guys, it was amazing to me how they felt like the last 2 years were just going to continue and everything was going to be hunky dory. When they were getting 20%, rent increases. And it's, in my mind, it was like just completely not sustainable. And yet from their attitudes, it was like, oh yeah, sure. We're going to be able to get that. No one was willing to admit that was a complete anomaly, and, enjoy it while you can.
Mm-hmm.
So I think, definitely look at rents. There was some data that came out a couple months ago about re-ups in terms of renters. That was going down as, with the price increases. People were tending to go to, 3 or 4, people in a 2-bedroom rather than 2 people in a 2-bedroom. Some folks, going back, even more living with parents rather than having to go to a higher rent rate, that kind of thing. So there's a lot of interesting dynamics that are happening. Similarly, I took my cue from Stephen this morning. I read my Wall Street Journal. Yet another article that was on there was sort of these stealth layoffs that's happening among companies where they're tightening the screws on their employees and beginning to see people leave as opposed to layoffs. So we could well see a softer labor market coming forward, which again, going back to the contrast between the 70s and the 80s, so potentially a big difference. And I don't think we certainly haven't put the genie back in the bottle as far as real globalization and the ability to source labor, outside of our own borders.
Yeah, we're probably going to have another strong JOLTS number too come out, and it'll be surprising, and the market will say, this is what they say whenever they see a potentially higher inflation number, that we're in this mode where we're going to have this permanently higher inflation. And I think that you just have to be careful not overreacting to any of the numbers that come out. They're 1 month things, and there's so many distortions in the economy that I wouldn't read too much into any one number.
Well, we've got a transition. I want to highly encourage everyone to just take the 2-3 minutes, particularly you, Duncan, and weigh in on how you see it. The factors in that form. I'll just throw it back up here again. 2 seconds. Just what's changed since the war started effectively? What scares and excites you? What do you find now attractive? What are you trying to get out of? How do you see the prospects of global, US, UK, Europe? How do you see the rates, inflation? And then by asset classes, what are you forecasting on returns? I think everyone should be forecasting higher, and they need to. You should be allocating if you can. But then it's that ratio discussion and classic public versus liquids discussion that we need to have, just to see where you're allocated. And then I threw this in just because Deepika from Blackstone was saying that she's using it. I asked a question earlier today to the London prep call, which you were not on, Mirana. We'll talk about that. Everyone's using it. It's a question of to what extent. The extreme being Carolina, I'm using it in everything I possibly can, to I'm sort of starting to use it. So and thanks to Kirash for helping us kick off those discussions. So that's I think that's it for the 151st. Appreciate everyone's time leaning in.